All right. Go ahead, Douglas.
Okay, guys, welcome to the Real Estate Macro Monday meetup. Joining us today is Dylan going to talk about the King Dollar and some hidden debt issues. And in fact, I'm really intrigued. I don't know a whole lot about what he's got teed up for today. So I'm going to go ahead and turn it over to Dylan to walk us through his presentation.
Perfect. Thank you, Doug. Um, yeah, so there was a BIS report that had come out about a month ago, maybe a little over a month ago now. And it was quite interesting to see how that report came out and what it showed as far as U.S. debt, where things were at, what kind of derivatives were out in the market, who was the players in that field. Um, so it is important to remember that the king dollar is what matters in the United States. So actually, even globally, our monetary and credit system is US dollar centric. The lion's share of international debt, trade invoices, asset classes, and Forex volume is settled or denominated in US dollars. Um, but oddly enough, even though that's the case, direct access to dollar liquidity is only available to entities in the United States. So, um, you know, the United Kingdom can't get access to US dollar cash. But in a credit-based system, the rest of the world also has an incentive to leverage in US dollars to boost or enhance their global business models because of how strong the dollar is, as well as because it's used so much, it creates that overall system for everyone to denominate everything that they do on an international trade level or business level in that. But that does mean that like European banks, Brazilian corporates, Japanese insurance companies, whatever you want to, put an example to, who want to do global business will most likely get exposure to dollar denominated assets and liabilities, debt, despite being domiciled out the United States. So it's a way for them to utilize US dollars without, of course, being here because they don't have physical access to it. So they use the credit system. The required US funding happens both on and off balance sheets, and the Forex derivatives market is an important part of the latter. And the focus of the latest BIS report that had come out is that has started to show kind of what is going on. So tonight we're going to discuss that paper and look at the hidden US debt story in as much plain English as possible. Raise your hand if you have questions. I'm tried to dumb this down as much as possible. And then talk about some conclusions and findings as well. But before we get started, I want to talk about some concepts. So say a Japanese insurance company wants to purchase US treasuries and needs US funding for the transaction, the same way a Brazilian corporate needs US funding to boost their international activities. US dollar bond issuance and repo funding are accounted on balance sheet and hence transparent and easy to track. We know that there's roughly 20 to 25 trillion of dollar denominated funding sitting outside the US. Pretty big number, but there's also ways to get US dollar funding off the balance sheet. And that's going to play into Forex derivatives. Forex swaps and cross currency swaps are what account for the lion's share of off balance sheet USD funding, or what the BIS called the hidden debt. And I know it sounds complicated, but it's not. Derivatives are pretty simple. A Forex swap happens in two steps. So I sell Japanese currency to buy US dollar. And then I agree with the counterpart to sell back to the US dollars and buy back the Japanese dollars at a pre-agreed price at a given date in the future. So for those of you who know options contracts, or it's kind of like putting something on consignment. You're going to take something now and you're going to pay it back later, but at a certain time with a certain fixed price. Or trying to think of another example. You could be like a real estate wholesaler. You buy it now at 25. You take it under contract for 25 million. You want to sell it for 28. You have 90 days to do that. So kind of that type of principle. But so we exchange the full principal at maturity. In other words, it's a loan secured by currency amounts, a property not common to all other derivatives, which makes the transaction similar to a funding deal. A cross currency swap is basically the same, but it's done for longer tenors or terms, and it requires exchanges of cash flows throughout the life of transaction. So it's more similar to a bond or like a loan in a way. So yeah, I think that explained it a little bit better. But why does the BIS tag US dollar Forex derivatives funding as hidden debt? Because accounting rules, for those of you who know common accounting practices, they allow for these types of things to happen whenever they do accounting. Forex swaps are reported on a net basis, while repo or bond issuance in US dollars is reported on a gross basis and hence immediately visible on the balance sheet. And as per any derivatives, Forex and cross-currency swaps require variation margin to be posted by the counterpart underwater, and hence their mark-to-market is continuously recorded, but on average it accounts for 5 to 10% of the notional amount. How big the notional amounts are, the BIS estimates roughly off-balance sheet US dollar funding from entities that are outside the United States is in the $1 trillion ballpark, or 3x recorded the one on the balance sheet. So annotate, I don't know how to do this, but we're on this one, so focus on that one. There we go. So the question becomes, when we're looking at a scenario of this, whenever we're talking about debt being held and margin calls, so on and so forth, is it going to collapse? Maybe, maybe not. It's all a lot more nuanced than it seems. So notional amount in derivatives generally matter very little. These contracts are often used to offset existing positions, and most likely essentially the clearinghouse takes care that the continuous mark-to-market and margin positioning exercise. So we have to look at who the players are that are involved in this and what they're really offsetting existing positions. So here is what shows that, and the BIS shows that they are playing in that market to an extent. Now, the Forex derivative notionals, so it's going to be this chart here, sorry. Forex notionals, red, which is the red there, and then sitting on corporate and banks balance sheet outside the United States show a positive relationship with the amount of world trade, which is the black line here. So say that again, the Forex derivative notionals sitting on corporates and banks balance sheets outside the US show a positive relationship with the amount of world trade. So world trade keeping up with the debt that they're issuing. The debt that they're issuing is coincident with the amount of world trade that's going on, or at least so it would appear. $1 billion increase in quarterly global trade happened over a 6-month period is associated with a 660 million increase in corporations' Forex derivative position. So it does match up pretty well. Plain English, if a Brazilian corporate gets continuous access to dollar cash flow because of its flourishing trade business, using Forex swaps will actually be a risk mitigating exercise, as it allows them to smoothen their currency risk as they move forward and continue to expand their business and do global trade. Um, there's still some things to worry about, which puts their material on the downside. So two problems. One, plenty of US dollar funding needs for entities sitting outside the US. So a bunch of entities outside the US are the ones who need the funding. That means a continuous flow of fresh dollars is needed for the system to stay in equilibrium. Kind of like how we're seeing right now with inflation. We injected a bunch of cash into the system, it broke it. Same kind of principle can happen here. There's a clear maturity mismatch between US dollar funding and assets, and hence rollover risk during stress times. Like I said earlier, these contracts are on a fixed time frame to be payable at a certain date in the future. However, they do typically have a side letter or an agreement internally that allows them to roll it, say, to the next 3 months. So if it's on the 3 or 4x swap, and I'm not, say I take it today, I'm not ready to pay it in March, I can roll it to June, and then I can roll it to September, and you can do this over and over and over again. But whenever you have a mismatch, the rollover risk during stress times becomes, what if lenders step away and you can't write your swaps anymore, you can't roll over, and whenever you're an entity outside the US and you need your US dollar funding to keep going. This chart, I feel, depicts the problem one being continuous cash flow. We have year-over-year trend in Korean exports in our blue here, as well as that is put against the performance of the US dollar, DXY, lagged by 9 months and inverted. So you can kind of see different crosses that happen there. But as long as exports are growing, US dollars are organically flowing to Korea, and the US dollar doesn't appreciate against other currencies. It actually often depreciates when global trade growth is strong. But if the trade growth music stops, our blue line down in Korea there, the US dollar often rapidly appreciates, our orange line, a few quarters later. So we're already starting to see that happen. What that means, we'll get to that later. But why does that happen? It's because a Korean exporter, in this example, has leveraged its balance sheet in US dollars to enhance its business growth, won't have a problem in periods of strong growth, like we've seen basically since 2011. 2008, you can make a case for since then. But as dollar organically flow, the Korean business owner can easily service its dollar denominated liabilities. But when these US dollar cash flows dry up as the economy is weakening, all of a sudden servicing debt becomes hard, especially when it's in US dollars. You're having to pay more Korean dollars to service the same amount of debt. But whenever interest rates are rising and the dollar value is rising, your currency is falling, it creates a huge problem. Imagine all of a sudden you had to start paying 50, 75% more on your mortgage month over month, or every 3 months that kept increasing. That's kind of the situation that happened, except maybe a little worse, maybe not, just depends on the contracts they have. But when the US dollar cash flows dry up as the economy is weakening, again, it just becomes hard. So in a snowball mechanism, all foreign entities leveraged in US dollars try to deleverage, which means they bid up the spot on the US dollar itself, which in turn hits other foreign USD borrowers in a self-fulfilling prophecy. So it's a rush for the exit doors. Everyone's kind of heading towards the fire escape, and if you get knocked down, you're going to get crushed and stepped on and trampled. And it becomes a US dollar wrecking ball for every country out there denominating US dollars. The other problem with this system is that off-balance sheet USD funding in derivatives is often very short-dated. So Forex swaps generally mature within 1 year. It's like you're getting a worse version of an Ethan Gal loan.
Hey man, you mean it's gonna be more expensive, or the person giving the loan is less handsome?
It's gonna be more expensive, and they're still gonna take your stuff.
Oh, okay. So it really is worse.
Yeah. The handsome part, maybe we'll see. But so let's go back to the Japanese insurance company because it's gonna make more sense for this. So Japanese insurance was very heavily involved in purchasing 10-year plus US treasuries and funding their dollar in, or their need for dollar rather, in forex swap markets. So they would sell Japanese to buy USD, purchase US treasuries with it, and agree to pay back US dollars for JPY. For long periods of time between 2010 and 2020, it was very lucrative exercise. They made billions, if not trillions, of dollars doing it. This chart here on the left shows the additional yield the Japanese insurer or insurance company would need to get from purchasing 10-year treasuries and hedging US dollar to Japanese won. So hedging the USD JPY risk with a 1-year forex swap instead of buying Japanese government bonds. This yield pickup was often in the 100 basis points area. Today, the forex hedging costs are so high that this yield pickup has disappeared, very similar to the 2005 through 2007 period. Had a nice peak in here, 2004, 2005, plummeted off. Nice peak here going into 2020 through 2021, large sharp fall off. Right into what we're seeing. The asset, the U.S. Treasury tenor is 10 years, while the funding forex swap is 1 year. So you have a U.S. Treasury with a duration of 10, counterparting a swap that they're using with a duration of 1 year. So the Japanese insurance companies would need to roll over their forex swap every year. But as I stated earlier, as everything comes to shit, the rollover becomes more and more expensive. The hedging side becomes more and more expensive. It costs more of their local centric dollars to pay off the same amount of debt that they're holding on the U.S. balance sheet. So they're moving it off, doing swaps. It becomes more expensive, and it's a rinse and repeat cycle. Actually, in September of 2008, the forex swaps market froze. The one year US dollar to all currency forex swaps became 100 basis points more expensive, and foreign investors were left in an absolute panic. Now, the swaps work fine if there's little volatility, and lenders of US dollars in the swap market, which is going to be our biggest banks like JP Morgan, Charles Schwab, Morgan Stanley, are there to cover things. But what happens when they're not? And again, we did see that in 2008. But wrapping it up a bit here. So tens of trillions of dollars of off-balance sheet US dollar funding exposure sounds pretty scary, yet deeper assessment points to a more kind of nuanced and we might be okay. But first off-balance sheet doesn't mean it's going to blow up. These derivatives require variation margins, and their mark-to-market is constantly taken into account. Secondly, a good portion of US dollar funding offsets existing dollar positions. So a Brazilian corporate selling commodities in US dollar actually mitigates its risk profile by hedging future dollar cash flows in the Forex swap market. In any case, the current dollar-centric model, which incentivizes foreign entities to borrow in US dollars, is definitely prone to strains. And I do feel that we will see some strains happening, especially due to the amount of debt leveraging that not only we have done here, but the rest of the global market with weaker central economies have leveraged as well, comparative to us. Because plenty of US dollar funding needs for, or there's plenty of US dollar funding needs for entities sitting out the United States, means a continuous cash flow of fresh dollars needed to keep everything kind of in balance. And the maturity mismatch, again, between the US funding and assets, putting over that rollover risk into play, giving everyone the fear of what if lenders step away exactly when you need to roll over your contracts or your swaps, just like happened in 2008. In the only thing we really can do is monitor global trade growth and different types of data that are coming out of the derivatives market to kind of feel the pulse on what's going on. There's no real way to know day by day. Just kind of have to take the reports one at a time. If a report comes out after something, you're going to know one way or another. I'll promise you that. You will know either by a report or because everything has gone down and it's a bad day. But that kind of wraps up the so-called hidden U.S. debt that exists out there, held by a lot of other countries, held by the United States itself, moving it off books, kind of what it means. Is it a big deal? Is it not? So on and so forth. But that will conclude tonight's presentation on hidden U.S. debt.
And Dylan, if you wanted to keep an eye on this or check into it or start watching this, where is there any one place to look at the data points to kind of track it and see how it's going?
Just Google BIS report.
Okay.
Actually, I can. Let me see if I can pull up their website here. It's an annual report, so you won't be able to really see much until next year due to its annual report. There are some publications that come out every so often. Other than that, you're gonna have to download a trading software on your computer and start looking at different swap rates and what's going on, tracking all of that data, watching inflows, outflows, stuff like that.
Mm-hmm.
It's a hard thing to watch if you don't know how to. Let me. Yeah. Okay. So they only do the report once a year. I thought so. So you can check back in a year, or start playing in the derivatives forex market. That'll work as well, and start watching that.
So
currencies could be a good one to watch too. Watching how the U.S. dollar relates to a lot of other currencies. That could be a sign as well.
I was going to say TD Ameritrade or somebody like that might be a good little place to check that out.
Absolutely. Alrighty. What else do we got going on?